Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the world of corporate filings. So you don't have to. Today we're cracking open an 8K report from MSA Safety Inc. Don't let the name fool you, this isn't just about hard hats and safety goggles, although those are part of it. This report reveals some serious financial moves they've been making, and it might just surprise you how these changes could affect the company's future. This 8K filing dated April 1, 2025 signals some big changes to MSA Safety's financial agreements. Think of it as them rearranging their financial furniture, securing new loans and adjusting old ones. But why now, and what does it mean for the company and its investors? Let's find out. First up, they've entered into what's called a fifth amended and restated credit agreement. In plain terms, they've reworked their main loan agreement. This credit agreement means they now have access to a line of credit up to $1.3 billion. It's like increasing the limit on their corporate credit card. They also made amendments or changes to existing agreements they had with other companies. Let's talk about that credit agreement because it's a big deal. On April 1, 2025, MSA and some of its subsidiary companies signed this agreement that allows them to borrow up to $123 billion. Think of it like having a giant safety net of cash they can tap into if they need it. This agreement replaces their old one from May 2021. It gives them more flexibility in how they manage their money, but it also comes with some strings attached. Under this agreement, MSA can borrow the entire $3 billion if they need it. Some of their subsidiary companies in the UK can also borrow, but only up to a certain amount. That amount is either $400 million or 15% of their total assets, whichever is higher. There's also a smaller amount set aside for what they call letters of credit and swing line loans. It's like having different compartments in their financial toolbox for specific needs. The company can also ask to increase the amount they can borrow by another $500 million. The current credit agreement expires on April 1, 2030, so this agreement lasts for 5 years. Now, how does MSA pay back this money? Well, the interest rate on the loan depends on a few different things, like the base rate, a term SAFR rate, a euro currency rate, or a daily simple RFR, plus an additional percentage that depends on how much debt MSA has compared to its assets. The higher their debt, the higher the interest rate. It's like a financial incentive for them to keep their debt under control. The base rate is calculated daily and is based on things like the prime rate, an overnight bank funding rate, or a reserve adjusted daily published daily simple SOFR plus 1%. Basically, it's tied to what's happening in the overall economy. The interest based on this rate is paid every 3 months. In January, April, July, and October. Interest based on some of the other rates, like the term SOFR rate, is paid at the end of each interest period, unless that period is longer than 3 months. In that case, it's paid every 90 days. This credit agreement also has a few rules and limitations that MSA needs to follow. They need to maintain a minimum fixed charges coverage ratio of not less than 150 to 1.00. They're in 3 months after certain acquisitions or purchases. This net leverage ratio is calculated by taking their total debt, subtracting any cash they have over $20 million, and then dividing that by their earnings before interest, taxes, depreciation, and amortization, which is a mouthful, but it's a common way to measure a company's financial health. This agreement also limits what MSA can do with its money. For example, they can't take on too much additional debt, create too many lends, make too many loans or investments, or sell off too many assets. There are some exceptions, but the overall goal is to make sure MSA doesn't take on too much risk and can pay back the loan. Finally, there are some events that could trigger a default, meaning MSA would have to pay back the loan immediately. These include a change in control, which means someone acquires 50% or more of the company's voting stock, or defaults on other debt. If you want all the nitty-gritty details, you can check out the actual credit agreement. It's listed as Exhibit 10.1 in this filing. So what does all of this mean? Well, on the surface, it looks like MSA Safety is just refinancing its debt and giving itself more financial flexibility. They're basically getting a new credit card with a higher limit and better terms. But it's important to remember that debt is a double-edged sword. On one hand, it can allow a company to grow and invest in new opportunities. On the other hand, it can also be a burden if the company can't generate enough cash to pay it back. Looking at MSA Safety, they have a history of making strategic acquisitions. This new credit agreement could give them the firepower they need to make even bigger deals in the future. However, they'll need to be careful not to outdo themselves and risk violating the covenants or rules in the agreement. Overall, MSA Safety seems to be in a solid financial position. They have a stable business, a good track record, and a strong management team. This new credit agreement should give them the flexibility they need to continue growing and creating value for their shareholders. But as always, it's important to do your own research and consider the risks before making any investment decisions. That's all for this episode of Corporate Decoder. If you enjoyed this video, please like and subscribe to our channel for more deep dives into the world of corporate filings. And as always, thanks for watching.